All right, cool. Well, if nothing else, this highlights that anything that can happen will happen, not only for life, but for audits as well. And that's something we're actually going to talk about today. So again, my name is Jason Figgett. This is Christopher Beckett. We are both practice leaders here at Pension Insurance, and we will be presenting to you this webinar today. So go ahead. There we go. So just a little bit of background about who we are and what we do here at Pension Insurance. We are a single service firm, which means we only do benefit plan work. I like to actually think of us, as, a lot of us, as recovering corporate auditors, because no longer do we moonlight as tax accountants or tax preparers or doing corporate audits or other sort of work. This is the only thing that we do. And in terms of overall practice size, we're very happy to say that in 2023 we audited over 900 benefit plans, which consisted of approximately $19 billion in assets and approximately 510,000 participant accounts. It's actually good enough to make us the 15th largest benefit plan practice in the United States. And we're very, very proud that we've been able to achieve that all through organic growth. Go ahead and move forward, Chris. In terms of our vision and our mission, we really, from a vision standpoint, we seek to become a national leader in the area of retirement plan audits in both in quantity, quality, also in subject matter expertise. And that really our mission is to deliver value and education to our clients, and by extension, any of our service providers or referral sources who may be joining us today, through our retirement plan audit process by cultivating a team of experts who provide the highest level of service and efficiency that we possibly can for our engagements. So in kind of as an overview of what we're going to be discussing today, we're going to begin by discussing exactly when a benefit plan is needed, the process of selecting a plan auditor, the DOL audit quality study, the documentation that generally you're going to need during a benefit plan audit, honestly, regardless of whether or not it's with us or another audit firm. How you may utilize service providers if you're a plan sponsor, and conversely, if you are a service provider, how you may be able to be proactive in helping to reach out to your clients to better support them in their audits. Common audit findings that we typically see with our engagements, particularly on first time audit engagements, and a general overview of the audit timeline, both what we strive for here at Pension Insurance, but also, again, in general, what you would expect to encounter regardless of whatever benefit plan audit firm you choose to use.
So who needs an independent audit? Who needs an audit for their retirement plan? So the participant count is what drives the audit requirement. And generally, they use the beginning of year participant count. So for calendar year end plans, you're looking at your January 1st participant count. And as long as that plan has 100 or more account balances, the plan is considered a large plan as opposed to a small plan. And we have a little asterisk there that states that as of 1/1/2023, the definition of a participant is anyone with an account balance. So this is either an active employee that's participating in the plan with an account balance, or a terminated employee that has an account balance still with the plan. This is a change from prior to 1/1/2023. It included active participants that are participating in the plan, active employees that are eligible to participate but not participating, or terminated with account balances. So really the new rule starting at the beginning of 2023 has helped simplify determining whether a plan is considered a small plan or a large plan, and a large plan being 100 or more participants. Well, you might ask, so if I have 100 participants or more, I need an audit, correct? Not always. There is what's called the 80-120 rule. And what that states is if your plan, as of the first day of the plan year, has between 80 and 120 participants, you can or you may file as the same status as you did in the year before. So example number one, in the prior year, the plan was a small plan, had 90 participants, well below the 100 participant threshold. In the current year, the plan shot up to 118 account balances, 118 participants. This 81-20 rule allows the plan sponsor to elect to file as the same filing status as the previous year. So in the previous year, as a small filer, you did not have to have audited financial statements attached with your regular Form 5500 as opposed to a short Form 5500. You can continue to file as a small filer for that year. And that continues indefinitely until the beginning of year participant count exceeds 120, so 121 or more. On the flip side, going from a large plan down to a small plan. In the previous year, you had over 121 or more participants, so 122 in this case. And in the current year, your beginning participant count fell to 118. This doesn't help plan sponsors going from a large plan down to a small plan at this point, because you may file as the same filing status as you did the year before if you're between 80 and 120 participants. However, because your previous filing status was as a large filer, you are still required to file as a large file with a regular Form 5500 and audited financial statements until you fall below 100 participants as of the beginning of the plan year. Now, you might ask yourself, what's the 80 related to there? 80 to 99 mark. At this point, you no longer need an audit if you fall below 100. However, you may file as a large filer should you choose to do so if you were a large filer in the year before. Now, I haven't really seen that put into practice. Generally, we state if you can avoid the audit requirement and the fees associated with that, we highly encourage that. So we highly encourage our plan sponsors to seek out ways to either using their third-party administrator or their advisor to help lower their or keep their participant count below that 121 threshold if possible, typically using force outs of terminated employees if possible. Selecting an auditor. Now, your company's corporate financial statement auditor or tax preparer, they might not be the best solution for your employee benefit plan auditor. Employee benefit plans have become increasingly technical, specialized, and regulated. And as such, we've seen increased regulatory pressure from the Department of Labor related to these benefit plan audits. The Department of Labor has also instructed peer reviewers, so other CPAs that peer review audit work papers, to ensure that they're more heavily scrutinized going forward. So both on the peer review side and a DOL inspection, the amount of documentation and work that's needed with retirement plan audits has increased substantially just over the past several years. And when the Department of Labor comes in and takes a look at their work papers, the worst thing possible is if they find a deficiency with your work papers, which can result in the DOL rejecting your 5500 filing due to an insufficient audit and requiring that plan year to be audited again by a different CPA. So there are some ramifications time-wise, and then also fees and penalties that may be assessed by the Department of Labor if that filing were to be rejected. The DOL about every 10 years puts out an audit quality study since 1988, and over time we've seen, I wouldn't say it necessarily an increase, but we've seen some substantial deficiencies, or they found some substantial deficiencies with the audits that they've chosen to inspect every 10 years. Our latest DOL audit quality study came out at the end of last year, and what they found was that of the plans that they looked at, of the audits that they looked at, there was a blended 30% deficiency rate with at least one major deficiency in those audit work papers, which by all means is not good. So 3 out of 10 audits that they found that they looked at were deficient. It's a step down from about 10 years ago, which was almost 40%. However, 30% is still not a great metric to look at here. This is how their DOL study is broken down. They take a look at auditors that perform 1 to 2 plans annually, 3 to 5, 6 to 24, 25 to 99, and over 100 plan audits annually. And what they found was that retirement plan auditors that are specialized in this area, perform more plan audits per year, have a lower deficiency rate than those that perform less, which makes sense because they're more well versed with recent regulatory changes and what to look for and test for when they're conducting their audits. The DOL did find though that auditors that audit over 100 plans have at least half the deficiency rate of plan auditors that audit less than 100 plans. So when taking a look at potential plan auditors for yourself as a plan sponsor or for your clients as either an advisor or a third-party administrator, that's a great place to start, is determining how many plan audits does this auditor conduct on an annual basis. Again, these audits by the Department of Labor, they were looked at based on professional auditing standards, and a blended rate of 30% deficiency was found. Again, higher deficiency rates with those that perform less audits. And what this could result in is a potential rejection of the Form 5500 filing. So in summary, what this really stresses is the importance of an experienced auditor that has expertise in its niche area, and firms that perform plan audits that perform more plan audits had fewer deficiencies that were found by the Department of Labor. So some questions that you might ask your potential CPA who's bidding on your employee benefit plan audit. How many benefit plan audits did they perform during the year, and what types of plans did they audit? Did they audit only defined contribution plans? Were there benefit plans involved? ESOP plans, we see a few of those over the years. The amount of plan-specific training that's possessed by a CPA. So do the CPAs that are working on your benefit plan audits, do they receive training on an annual basis related to employee benefit plans, or is their training a more broad level of training related to other areas within accounting? What's the firm's commitment to plan audits? What percentage of the firm's revenue is driven from EBP sources? Or is this summer filler work? Is this work that's used to protect higher revenue streams, such as tax work or a corporate financial statement audit? What's the specific team experience? Who's going to work on your audit? Is this the same person that's worked on your audit in previous years, or is this someone new every year? Are we going to basically be churning and burning through staff that are unassigned at the time? Is the firm a member of the AICPA Employee Benefit Plan Audit Quality Center? Definitely check with your state board of accountancies to determine if the CPA is licensed to practice in your state. Some states have reciprocity. Others require the firm to register in specific states before being able to conduct audit work. Does the CPA have any DOL findings from their latest DOL inspection? And same thing with their peer review. You can always ask for a copy of the audit firm's latest peer review report. And then audit fees. There shouldn't be exorbitant audit fees. These are qualified plan expenses and can be paid through plan assets. But when performing your due diligence, you should take a look and determine, how much is this audit fee and what level of experience and expertise am I paying for with this particular audit fee? Is it even an audit? ERISA Section 103A3C audit, which was formerly referred to as a limited scope audit, essentially says that we are allowed to carve out investment related transactions and balances during that year. And this is done through a complete and accurate certification from your record keeper, from the custodian, insurer, or trustee. But this is still an audit. We still are providing an audit opinion. It's no longer a limited scope audit. And what we're able to do, rather than look at investment balances at the end of the year and transactions during the year, we focus on participant and plan level transactions. So plan and participant level contributions, distributions that the participants are taking, or loan requests, vesting if the plan has employer money source that's subject to vesting. We take a look at participant data that the record keeper is holding, such as hire dates, birth dates, term dates, and anything else really that doesn't directly pertain to investment valuation, whether it be income, earnings, losses, dividends, interest, or the actual investment balances as of the end of the year. Everything else other than those investment related items are still in scope for the audit. How can we leverage our service providers? I know we probably have a number of financial advisors and third-party administrators or TPAs on the call today, but plan sponsors, these are the individuals that we as auditors and you as a plan sponsor can leverage for us to help with the audit, and then for you to help manage and oversee the plan's function. So auditors, and I think everyone involved in the retirement plan space knows that that the retirement plan is not the sole focus, and maybe even the primary focus of the plan sponsor, which is why it's important to have a good team surrounding the benefit plan, such as a good third-party administrator, financial advisor, and auditor. As the auditor, we are obtaining information from the financial advisors, such as plan committee meeting minutes. This gives us a good idea of what to expect if there's been any changes to the plan or any potential changes during the plan year under audit or subsequent to year end. Third-party administrators who are helping with the administration of the plan, including 5500 preparation and non-discrimination testing. They're also assisting in plan design and retention of important documents. We'll cover that a little bit later. And then if there's any problems that are identified during the audit or by the plan sponsor, even the TPA, they're the first level of assistance when it comes to making sure that things get corrected timely and effectively. So lastly, we've got the record keeper or custodian here. They're typically the individual or the service provider that's maintaining the participant and plan level records. And during the audit process, you should be expected that your auditor is going to request auditor access, which is an ability to download and run reports from the record keeper, so that basically the auditor can circumvent the plan sponsor and go directly to the source to obtain the information needed to populate our audit files, populate the trial balance, and draft the financial statements. Speaking of those required documents, here is a general list of PBCs or prepared by clients that we have here. I'll go through them in some detail now, but the plan documents, adoption agreement and basic plan document, these are the governing documents that dictate how the plan should be operating. This is basically the start of our audit process here, determining what and if to audit certain areas of a plan. Although retirement plans are fairly basic in terms of how they change, they do change in some specific ways from plan to plan. So it's good to know as we get into the audit what we should be looking for. We have an IRS and opinion letter and determination letter. So the opinion letter is the blessing from the IRS that the document that you're using is been approved and the plan is qualified and the trust is exempt. The determination letter is the same thing except for plans that have been designed outside of typical plan design. So basically it's saying the IRS has reviewed a plan sponsor's current design in its form and has determined that it is acceptable based on their understanding. And then we have plan amendments. This is any changes to the latest adoption agreement or restatement. This can be done either through a restatement, but oftentimes if there's one plan provision that's changed, there will be one plan amendment for a specific plan provision that's changed since the latest restatement. And then the summary plan description is a basic plan description of the plan's provisions that's provided to participants. This has a lot less weight when it comes to how the plan should operate, but it gives us a good idea of what to look for and what's been communicated to participants. Just a little bit less authoritative than, say, an adoption agreement or basic plan document. As mentioned before, we take a look at meeting minutes, service agreements between advisors, record keepers, third-party administrators, specifically the fee agreements to test fees that are paid from plan assets. I mentioned the service providers, the record keepers. We obtain auditors access, and from there we'll obtain a complete and accurate certification, allowing us to perform that 103A3C audit, carving out the investment related items. We look at the plan year-end statements, participant statements, including loan details and distribution details from which to make our selections from. Continuing on, we also received the SSAE 18 report or SOC 1 Type 2 report. This is the design and testing of controls at the record keeper. We use this to document our consideration of those controls, which allows us to perform that 103A3C audit. So this is typically performed by one of the larger firms, your Deloitte's, KPMG's, BDO's, and they're conducting the audit of controls at the record keeper from which other auditors can rely upon. We usually receive the non-discrimination test in a bundled plan. Just for a little bit of information, a bundled plan meaning the record keeper and the administration are combined. There's no outside or third-party administrator. The record keeper in a bundled plan will be providing the non-discrimination testing and other annual administrative tests, plus the 5,500. In an unbundled plan, meaning that the record keeper and the third-party administrator are separate, the third-party administrator is performing the non-discrimination testing and drafting of the 5,500, among other things. The plan year deposits will have a sample deposit schedule, I believe, on the next slide. Typically, this can be received from the record keeper, and then we send it to the plan sponsor to fill in any missing information like paycheck dates, or make sure that the information is complete and accurate before we use it for audit purposes. Subsequent year-end statements, we're looking at that just to make sure there hasn't been anything extraordinary that's occurred after year-end. I mentioned the 5,500. If there's been any non-elective or profit-sharing contributions, we'll obtain that calculation. We'll obtain the true-up calculation if there has been one, and any discretionary matching formulas if that's applicable to the plan. For the plan sponsor, the main bulk of the work that we're performing will come from two different payroll reports, one of them being the last paycheck date of the plan year, and the other being the year-to-date payroll register showing information for all paycheck dates that occurred during the plan year. From these, we can perform about 90% of our testing. And now this isn't all that we look at. We will request at some point additional information for participant specific related requests, but this allows us to perform about 90% of the testing before even getting to that point. And then required plan documents for first year. We look at the prior year 5,500, which is either coming from the plan sponsor, can be obtained online. 5,500 filings are public information should you know how to look for it, whether it be through the plan name or the EIN. The fidelity bond or crime policy with ERISA endorsement. This is the insurance policy that covers the plan from any employee theft or misuse of assets. This is a requirement for plan sponsors to carry by law. Auditor access to the record keeper's website. Again, we can obtain almost all of the information we need except for payroll and HR related requests from the record keeper site. This allows us to circumvent the plan sponsor and removes any unnecessary requests, especially because we're very familiar with the sites, considering we do about 900 of these a year. And then again, the copy of the payroll registers for the last year, the previous year, so that we can do some look back procedures. If the plan has been audited by a firm in the past, we'll get an introduction to them and review their audit work papers. And then if the plan has not been audited in the past, we also take a look at the prior year non-discrimination testing, make sure that we don't need to accrue any payables from the previous year since the financial statements are on an accrual basis. Here's that sample deposit schedule. I mentioned that Jason will get into at a later point some common audit findings, but one of the things that we look at is the days to remittance. This is the timing between the paycheck date and the deposit date. And the Department of Labor states that the deductions from participant payroll need to be remitted to the plan as soon as administratively feasible, but in no event later than the 15th business day of the subsequent month in which they were withheld. Again, I think Jason will go into more detail about that later, but although this is something that we can obtain from the record keeper, I do say that this is a best practice for plan sponsors to maintain on a per paycheck basis. That way they're aware of the amounts that are being withheld from payroll and the amounts that are being remitted to the record keeper. And that way they can keep track, make sure things are making it into the plan completely, accurately, and in a timely manner. I think this is you, Jason.
It is. Thank you.
Yep.
So As Chris was mentioning on the prior slides when he was going through the information that we typically gather from from clients or requests from to have service providers assist us in collecting relate to beginning balance work. And you might be thinking, well, why are you interested in the beginning balances? And the reason for this is when you look at an audit report for any benefit plan, you'll notice that there are two statements that come after the auditor's report, a statement of net assets available for benefits and a statement of changes in net assets available for benefits. That statement of changes report is required to present the ending balances from the prior year and the current year. So for the vast majority of plans, unless your plan is newly incepted, you're going to be presenting effectively two periods of data. You're going to be showing the last year or period end and then the current year end's data. Whereas the statement of changes only covers typically the activity from that prior period or year end to the current year end. And because the way that data is then presented, we as auditors are required to be able to definitively say that we are comfortable with all the information that's being presented. And so that's why when we are asking for these for any first-time audits for data related to the prior year, that's why. Again, we really try and keep it concentrated on just those ending balances being reported. So typically that's assets held, and then an assessment of whether or not there's any receivables that need to be captured as of the prior year end, and whether or not there are any liabilities that need to be recorded related to the prior year end. Receivables for benefit plans are typically oriented around just the timing of when contributions are received by the plan, and typically liabilities for an employee benefit plan audit are centered around whether or not there were failings of any non-discrimination testings in prior years, whose correction requires money to be returned to participants. So when we're asking about prior year data, looking at opening balances, that's why we have to do that. In the instance where you either change auditors for whatever reason that may be, as Chris was mentioning, we will ask to be put in contact with the prior auditor. We will ask them whether or not we may look at their work papers to gain comfort over their audit methodology. If we are able to review their work papers, and we conclude that their procedures appear to be sufficient, we can rely on the figures that they provided in their audit report from the prior year and our current year audit report. However, some auditors either have policies where they will not allow us to look at work papers, or they'll charge clients to look at work papers. And in either one of those instances, our preferred approach, and I would assume the preferred approach for most other firms would be the same way, where we would say, okay, we are then going to request that prior year payroll information and non-discrimination testing results and what have you, to try to determine whether or not we agree with the figures that are being provided in that prior year audit report. And assuming that we do, we just bring them forward into our current year report. So that's a little bit more information about beginning balance work and why we're assessing that when you're thinking, but we're talking about the current year. Why are we digging up the past? It's what we auditors do. Go ahead and move to the next slide, Chris. All right. So actually, this next month or so, we're planning on doing a completely separate training webinar, whatever you want to call it, specifically on common audit findings. But we are, as Chris was mentioning previously, there are a couple audit findings that we do find occur more frequently with our first year or newly audited plans with us, versus those that have maybe been with us for a little bit longer period of time. As Chris was mentioning, one of the things that we are very keenly interested in is the timeliness of participant contributions. Chris already shared the rule, it's a mouthful. Where we typically find new clients or new plans run into problems is that when a plan is a small plan, they technically have a 7-day safe harbor under which they can operate. So as long as the participant contributions, so that's participant deferrals and loan repayments, as long as those are with the time between when they are withheld from participants and when they are deposited into the trust. As long as that period of time is less than or equal to 7 business days, they're operating within a safe harbor. Unfortunately, that safe harbor does not exist for plan once it is considered large, as was discussed earlier, the definition of a small versus a large plan. And so you may be thinking, well, what's the rule for these larger plans? What the rule that Chris shared is the, for lack of a better term, a line in the sand the DOL has provided to us, and effectively says that in no circumstance are these deposits ever to be allowed to be counted as timely. The problem is any point in time between day 0, when the deposits are withheld, and ultimately that 15th business day of the following month rule, that entire window of time is basically up for grabs. And depending on what your risk tolerance is, will greatly dictate how and where you determine delinquent contributions to be. I want to say it's a guessing game because there's a little bit more goes into it than that, but it's extremely flexible with what you as plan sponsors can determine. I will tell you that the primary metric by which we operate as auditors, and I think any auditor would take this position, is that we are going to look at how frequently or how timely you can typically remit to the plan within a window of reason. So for example, if someone were to say to me, we typically are able to withhold contributions and deposit them into the trust within about 3 to 4 business days, then I would argue anything that's 5 business days or longer probably should be counted as a delinquent contribution. Plan sponsor may disagree with that. That's their prerogative, but we will absolutely warn them that they may be bringing additional risk upon themselves that they may not have intended to do so. And in those instances, we will always recommend that our plan sponsors try to formulate a formally written set of policies regarding what they will determine to be delinquent versus non-delinquent, so it's not an arbitrary determination each time it comes up. And ultimately, the only time you're ever going to get in trouble with this is if your plan is picked for a DOL inspection. Just as we are subject to DOL inspection, so our plan is subject to DOL inspection. And in the instance where your plan is inspected by the DOL and they come in and they determine, well, this deposit that you said was timely, we disagree and it is delinquent. Congratulations, it is now delinquent. And you're going to have to both make a corrective contribution to the plan for the lost earnings. You will have to pay excise taxes on the amount of earnings that are deposited, and then the DOL might just throw in a fine for good measure on top of that because you weren't proactive in monitoring this in the first place. So in this instance, it does help to have a little bit more of a cautionary approach. But again, we're more than happy to speak with you, and I would assume any auditor would be happy to speak with you based upon their experience about whether or not a deposit in question should be identified as delinquent or not delinquent, and discussing what the ramifications of that determination are then with you. Another item that we typically see in terms of errors is the plan in operation is not in alignment with the documents which govern the plan. I will apologize in advance because anytime you work with an auditor in the compliance space, you might think these guys are being a little bit anal or overly picky about the implementation of the provisions. The problem is that's the same standard we are held to by the DOL and by our peer reviewers. The very nature of compliance audits is nitpickiness. The good news is that this is something I share frequently with either potential clients or when I'm networking with new service providers, is that I look at our role as almost being the practice auditors. If we find a mistake or an issue, as long as we can be comfortable that that potential issue will not quantitatively or qualitatively materially impact the financial statements that we are assisting you in preparing to deliver and attach with your Form 5500 filing, we can just write up a recommendation and point you in the right direction for how to fix it and move on with life. The DOL is going to make you fix it, and they're going to fine you for good measure on top of it. And so, or they're likely to. And so when we have findings, we are very keen in trying to work with our clients to determine, what's the potential extent of this error, and is there anything we can do to kind of get our hands around how big of a problem this actually is? And when it comes to those sorts of incongruencies between how the plan is being operated versus the plan documents, the first and foremost problem that we run into is definition of plan compensation. I'll just tell you right now, if you have a plan where you either recently changed service providers from one to another, or you had a recent change in payroll, or there are any changes in the pay codes which are in play, you should absolutely make sure that you're going and you're examining to make sure that your plan's definition of compensation is being properly deployed within the plan. And if you have any questions about that, your respective financial advisors should be able, or plan advisors should be able to help you with that. And if they are insured, you should definitely consider bringing legal counsel who specialize in these sort of compliance questions to bear on your problem to make the determination if you're not sure. Even the best run plans, it's not uncommon to run into definition of compensation errors. Eligibility and vesting are other areas where we frequently see there's some incongruencies between the operation of the plan versus the underlying plan documents. Most of the time, eligibility issues, when they are identified, can be corrected by just simply bringing the people online into the plan if you find it quickly enough. Unfortunately, if enough time has passed, then you may be required to make corrective contributions to the plan for any of those mistakes that were identified. And again, those corrections would cover both participant contributions and any associated employer matching contributions that would have been made had the deferral happened properly. With regards to not following participant instructions, you want to stay on top of this. Mostly because a participant who feels they're not being heard or the directions not being met, they are very likely to go complain to the DOL. And there's no quicker way to bring the DOL to your doorstep for a friendly chat than to have participants complain to the DOL regarding the timeliness with which their requested changes or edits are being processed. Most of the time these days, those types of requests are being done electronically online, so it's not as much of an issue. However, if your plan happens to have paper as part of that process, you want to be very mindful of this. And then finally, missed auto enrollment opportunities. This can kind of tie with eligibility, but regardless, the good news is that typically with auto enrollment errors, if it is found quickly enough, the answer may be as simple as just turning it on and getting them in there. But if enough time has passed, then unfortunately you're going to be stuck with having to making corrective contributions to the plan. You can go ahead and move to the next slide, please, Chris. So talking about then moving to the audit timeline, are we there yet? We're almost done with this presentation, but I also want to make sure that we also discuss a little bit about what the general audit timeline looks like. Really, the most important beginning point for your plan is going to be when the audit package is available from your respective service provider. Most service providers, I'll just call them tier one because they're the largest, the ones that we encounter the most. Most tier one service providers have their audit packages ready and delivered by no later than the end of April. There's quite a few who actually already have them ready by now. And so again, in our firm's instance, because we only do this work, we begin our busy season and benefit plan work March 1st. So we're already well underway with our benefit plan audits. Other firms you may be looking to work with or have clients with, if you're a TPA, or other service provider, typically you'd expect them to bring their audits online once they've gotten through most of their other audit work. So that'd probably be in the late April, early May timeframe. But regardless, the point is that the overall timing of your audit is going to be mostly dictated by when is the audit package even available in the first place. Once the audit package is available, we'll begin to go through our planning and selections process. That typically is a week or so after the fact, or after we are able to formally begin the audit work on your engagement. Once we have those initial requests, as Chris was outlining earlier, things like payroll and other information we know we're going to need regardless of the selections made. We'll be working on that in the background while the client is then working on any additional HR or HR related requests that we may have, or any other auditor honestly would have. Once we have the aggregation of all that information, it will then go to a manager for review. And then after the manager is done with their review, there will typically be, at any firm, but at our firm specifically, there will be typically 1 to 2 additional reviews after that point. So overall, we typically try to aim for a turnaround from when we begin the audit to its conclusion to no more than 6, maybe to 8 weeks. It can go longer if there's significant complicated issues that needed to be addressed in the background, and that does happen. But by and large, any auditor that you work with, you should be trying to make sure that you are aware exactly where you stand in that overall audit process. But I cannot emphasize enough that please do not lose patience with whatever auditor you work with. If they say, I'm sorry, the plan's being reviewed, because that review process on the back end can sometimes take disproportionately long. It's because we're busy. It's not because we're not trying to get your work done. It's just all this work comes in at the same time. And so we do our best to try and mitigate that and work through it as quickly as we possibly can. But do know that there is significant review that will be happening with really any engagement on the back end.
All right, so how do we stack up, and where is the Department of Labor? Just to kind of resurface this a little bit, where is the Department of Labor finding the best benefit plan audit quality? And that's in firms that audit more than 100 plans. Again, pension assurance, we do about 900 of these annually, shooting for I think about 950 by the end of the year. They found that greater than 10% of firm revenue from plan audits, they saw an increase in audit quality for those types of firms. Pension assurance, again, is singular focused, and 100% of firm revenue is generated from plan audits. So we're well above the 10% there. And then lastly, how much employee benefit plan audit continuing professional education is received by engagement partners. Engagement partners that receive 24 hours or more annually were found to have had audits that were significantly better in terms of audit quality. And then here, not only partners, but all professionals complete somewhere between 40 and 60 hours annually, focusing primarily on employee benefit plan audits. Every year in May, we attend the AICPA Employee Benefit Plan training seminar, which we get over 20 hours of continuing education just from that conference alone. And that's managers and above here that are attending that. So really, we check all the boxes there. And I'd say we're leading the pack. Our firm, again, is 100% specialized in retirement plan audits, meaning that this is our sole focus, and your plan is our focus. So we're not performing corporate financial statements. We're not performing tax work. This is what we've dedicated ourselves to, and every professional here has decided that this is going to be the area that they gain their expertise in. This results in pain-free audits. Our clients love our efficient and streamlined audit approach, and it's effective. We know how to work with your service providers. We know how to work with your third-party administrators and your advisors to help take you out from under having to do the grunt work when it comes to these audits, having to fulfill requests that can be fulfilled elsewhere. So really, again, pain-free client experiences. And our entire firm is dedicated solely to these audits. We have the highest level of commitment to quality, which means a superior audit experience for our clients, and also leads to competitive fees. Now, again, I'll say we won't necessarily be the lowest bidder on a plan, but when you couple the industry-leading expertise, industry-leading client experience, and match that with the reasonable fees at pension assurance here, you get shorter audits, you get a stronger and dedicated audit team that is going to most likely recur from year to year. You get superior audit quality and peace of mind when it comes to having an audit that's conducted effectively. And you get an excellent client to partner ratio. We have 7 partners here, and each one of them touches these plans. Not every partner touches every plan, but each plan has a partner associated with it that's heavily involved with the process. So just like to thank everyone for attending the webinar today. Hopefully it was informative. If you do have any questions or are seeking some assistance with your employee benefit plan audit needs, please reach out to Jason or me. And we've got QR codes there for our LinkedIn and the firm's LinkedIn. And again, we're very happy that we were able to put this on and that you attended. And we look forward to hearing from you, Jason.
Chris, there is one question specifically about cost. I know you did touch on that, but I did want to expand on that just a little bit. I'm a little apprehensive to give an exact dollar quote, mostly because there's a number of factors that go that go into it. Depending on who your service provider is, we actually will typically build in a discount for certain service providers who we know consistently provide easy access, sufficient detail and reports and whatnot. And there are other service providers we work with that we will have a premium attached to our audit fee, primarily because we know that their reports are either more difficult or problematic to work with. Not that we won't work with them, it's just going to take more time on our end to address. Certain one-off events such as transfers in, transfers out, changes in service providers during the year, those will carry certain one-time fees associated with them. But as Chris mentioned, we are not going to be the cheapest option on the block, but nor are we going to be the most expensive. We really do feel like we bring a unique value and perspective to the market overall when it comes to a fee perspective, because we really do offer superior quality, consistency in teams, just a kind of a peace of mind and helping to take a lot of that administrative burden in terms of actually functionally completing the audit. I will say that for many of our audits that we do, if it's a basic, streamlined, not very complicated engagement, it's not uncommon that our clients' total time necessary to support us is going to be no more than 6 or 7 hours in total to support the entire engagement. And it might even be less than that. Naturally, if issues come up, there's going to be more time involved. But honestly, we're very proud of the fact that we have created an audit approach that's very singular and focused and targeted and trying to minimize our footprint with our clients in terms of the impact that we have on their day-to-day operations. Because we're your additional job. We're not your day-to-day job. We're your and then some additional job. And we're fully aware of that. And we try to make sure that we're respectful of that.
Another question, do you audit MEPs and PEPs? Definitely, we're happy to discuss MEPs and PEPs and what that would look like with pension insurance. Just reach out to us when you're ready to discuss that if you do have a MEP or PEP need.
Sorry, I just saw that we did have another question about the range. Range of fees, it really depends. I will say that I recently had an audit that I proposed on that it was all the way down to 9,000, I think, but they only had distributions. There was no contribution activity. So it was very, very like even smaller. It was a terminating plan. So that was a very unique circumstance. We have audits that go like, pretty high depending on depending on how complex they are. We certainly, again, feel that it's going to be a pretty fair shake in terms of what you're going to get fee wise. So if you do have questions or you want more specific quotes, again, contact us so we can give you that, because we want to make sure that we're being very reasonable with like what type of fee that we're asking for the work to be done. Because all these, we already have kind of outlined budgets for what the expected hours are. And as long as we're covering our hours, we're not going to wring extra money out of that arrangement.
Do you do it all online or do you still go into the client office? Another question. We pretty much do everything online now. I can't really think of any exceptions to that at this point, or clients that would prefer to have us in the office for any sort of period of time. Most of the work that we're performing would be done on the back end anyway. So at the very most, it would be a half a day to a day at your office, which we find not only is more efficient to do it remotely, but also our clients like not having to set aside an office for us or a table and set aside time. And this way they can work on processing the test work requests on their time and then upload them to us, and then we can process as soon as possible thereafter. And then any sort of communication, like such as an internal control call discussion, we can do that via Zoom or Teams calls or phone calls. So really, A lot of these audits are done remotely, and there's not much need to go in office, assuming that the client prefers that. So we're
Yeah,
definitely not opposed to going in office, though, if that's a preference.
if you want us there, also be warned that we're all over the place. Chris is in Colorado. I'm in San Jose. We have most of our work, the greatest concentration of employees that we have are still down in the Los Angeles area. But I think now the majority of the firm is outside of California, or at least certainly outside the LA area. So we're all over the place. So if you were adamant that you wanted to see our smiling faces in person, absolutely we'd accommodate, but it's going to be more expensive. So most of the time we settle for cameras and we hope that we are at least reasonably photogenic.
We will be sending the slides. We have emails, so we will send slides. But if anyone has a burning desire to get the slides right now, just shoot Jason or me an email and be happy to shoot them out real quick.
Mm-hmm. Any other questions?
With the LTPT, do you expect to see audit plans to increase in the near future?
Do you mean, I assume you mean the number of plans that are like audit, that are required to undergo audit? Um, if so, yes, that combined with the new auto enrollment rule, absolutely. Yeah, well, I can see that. We're gonna be in a little bit of a lull, I think, here for the next year or two, overall, market wise. Just based upon those two changes, the recent changes and then those changes on the horizon, that's what I would generally expect to be happening in terms of overall activity. In terms of like, do we expect audit fees to increase as a result of this activity? Again, I would have to point to and say, how's the plan set up? There are some very good service providers I've spoken to relatively recently who have described to me how they're trying to get ahead of this with their clients and just set up eligibility so they're just in and they don't have to be tracking this sort of stuff. Because truth be told, it's my opinion that the law and rules surrounding this were not written in the best manner to exclude confusion and questions. And there's still a lot of kind of questions around some of the more nuanced aspects of how this is going to be implemented once it's fully online here next year, unfortunately. So I hope I answered your question correctly, Candace.
I don't see any other questions at the moment. We'll hang out
Oh,
for.
oh, someone beat you to it, dude.
Oh, you sure?
Yep, they responded. Okay, we're good.
Yep. Hang out for a few extra seconds. We'll send out the slides. And again, thanks everyone for attending. Hopefully it was informative, and we look forward to working with you in the future.